Dear investor, over the past period, equity markets have moved up and indices made new highs. At the same time, oil prices have also been up. Typically, a bump up in oil prices has been seen to be a cause of a market correction. A question thus arises if the up move in the market is sustainable in light of the crude prices rallying to around $95 per barrel. To try and answer this question, we would have a look at the various economic indicators over the past period and see how we were positioned as a country when oil prices spiked in the past and how are we positioned in the present. At the same time, we would have a look at the valuations and market compounding over a period of time to see if the markets are running ahead of valuations. Indian economy has strengthened in the last 15 years after Lehman and 10 years after the first taper tantrums. 10 years back when the Fed started to tighten, INR had faced a severe pressure and had buckled 20% in a short period of time, between May and September of 13. This time around it has been different. Last year, for example, in 2022, emerging markets were subject to another bout of pressure when the Fed started hiking in 75 bips increment, which sucked capital away from periphery to the center and caused US dollar to surge. Simultaneously, the Russia-Ukraine conflict caused oil prices to spike. For a capital and commodity importer such as India, a stronger dollar alongside higher crude prices, a phenomenon we are again seeing in recent weeks, was a double whammy, pressurizing both the capital and current account simultaneously. While the external sector was under sustained pressure for much of 2022, it did not show up in any large rupee depreciation vis-a-vis other emerging markets. In fact, rupee depreciated amongst the least compared to its peers when the pressure was on because the RBI aggressively intervened and sold dollars to the tune of almost 90 billion across spot and forwards between June and October of last year. Nothing cracked in India. No extraordinary interest rate defense was necessary. In fact, interest rate differential between India and United States progressively narrowed over 2022 as the Fed upped the ante. No external capital had to be mobilized and no special measures had to be invoked in India. It was almost as if it was business as usual. Key lesson learned from the last taper tantrum of 2013 was to create adequate forex buffers. That's increased from 6 months of imports in 2013 to 10.5 months of import in 2023. Swelling to US dollar 670 billion from 280 billion then. This gave RBI credible firepower to defend the rupee. Today we are again seeing higher crude prices and a stronger US dollar. However, this is happening when our current account is expected to be more balanced in financial 24 versus earlier. Our CAD, by the way, has continued to stay below 2.5% levels over the past several years, whereas earlier it had a tendency to shoot up, causing a crisis. In financial 24, even adjusting for a higher oil prices, it could be around 1.23%, lower than financial 23 levels of 2%. Hence, we believe we should be able to withstand this current period of stress, and there is a good prospects of our maintaining our forex reserves, if not increasing it a bit, as the table shows. Current account along with capital account, it could result in some surpluses. And we may not have to increase interest rates any further, even if we see an increase abroad. A US dollar 10 in oil prices increases the current account deficit by 0.35%. and hence oil prices would have to be kept under watch. But as of now, at levels that we are, it implies that the economy can continue on its growth momentum. Once again, as we have been pointing out previously, good forex reserves keep the external volatility out and gives us policy freedom, and should constantly be under watch. A decline in forex would enforce tightening, which would be negative for growth, but as of now, I think we are fine. Stress on banks on account of NPAs was a key consequence of Lehman collapse. Again, going back several years, over the years we have seen banks clean up their books, and today the bank NPAs are the lowest ever, with several banks having over provided for bad debts in their books. So just revisiting the past crises for the takeaways and the lessons that have been learned. In the US, the economy continues to be strong, stronger than expected in spite of Fed tightening, and there are prospects of interest rates staying higher for longer. In the last meeting yesterday, Fed pointed, while they kept rates on hold, they pointed to a lower amount of cuts next year, and that the markets are digesting. Higher crude prices would again seep into inflation, and that will have to be kept in mind. In India, again on the inflation side, rainfall has been below normal, and as of end of August, there has been a deficiency of 11% versus long period average. This has led to lower reservoirs levels, which could impact summer cropping. Government has acted proactively as far as inflation goes and has taken several measures to contain agriculture-led inflation, such as continuing ban on wheat imports and levying a 40% duty on onion exports for a period of time. This should help inflation in check. RBI has set for itself inflation targets. We have seen it act, and we have seen inflation stay within the RBI comfort band for most of the period from Lehman to now, and the current causes of inflation should also be taken care of. As noted earlier, the state of the economy overall is good, and RBI has greater degrees of freedom. Coming down to the next topic, how do the markets behave ahead of the general elections and immediately afterwards? General elections are just about 6 months away. Past trends of the elections have shown that markets stay buoyant in the run-up to the election and have a good chance of continuing the trend after election if the incumbent gets re-elected. More importantly, markets respond to policy making. We have seen disruptive reforms, which may be necessary, but when they happen, cause the markets to decline, while supportive policy making causes them to cheer. Continuity reduces the chances of disruption. So I think we stay reasonably confident in the run-up to the election. Policy making continues to be pro-growth in spite of the stress as discussed above. It is business as usual for India Inc. and the breadth of earnings should remain good. There is a good chance that RBI keeps the policy rates unchanged going forward, and that should help growth assets. Broad market earnings are expected to be more than Nifty earnings even going forward, and hence broad market performance in the stock market should be better than the large cap indices, and hence we continue to believe that it is time for alpha. Lastly, on valuations and flows, we expect FPI flows to continue to be volatile given the higher interest rates prevalent abroad and lower interest rate arbitrage available from Indian markets. Domestic flows, however, are proving to be very structural. Interestingly, SIPs now account for larger part of inflows versus one-time investments, and hence domestic flows are seen to be much more structural, and this provides the market with a lot of strength. Valuations are now at the upper end of our sustainable band. Our construct of the market is 18 to 18.5 times 1 year forward earning, which gives us a target of around 20,350 for Nifty on 1100 Nifty earnings for financial 25. This level has been broadly achieved. we would say 6 months before time, and this leads us to expect a slightly lower than earnings growth returns over the next few years. However, the earnings growth over this period should be better than long period average, and that would be helpful. Mid caps are trading at a small but sustainable premium over large caps. Given the strong presence of growth themes in the mid cap space, we do expect this space to continue to perform on a relative basis. Thank you. Happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.